Hello, I'm Tony Cordato,
And I'm Peter Koukoulas.
and we're here to talk about flags. Well, red flags when buying a home.
Yes.
So, Peter.
So we're going to talk about some red flags, and I'm not talking about the red flags at Bondi Beach, swim safely, but we're going to talk about swim safely in the actual finance game. So there's a couple of red flags, Tony, that I would like to discuss, and the 5 flags I want to discuss is, one is clients come to us, they say, oh, I went to the bank, I couldn't get the loan, they've knocked me back, or I've gone to a mortgage broker and they've shopped around with all these banks and I need help. I've got to buy this property. So the number one thing not to do, the first flag is job hopping. So jumping around from one job to the next job to the next job to the next job. So the banks look at 3 things: stability. Stability in your residency, how long you've been living at your place, whether you're renting.
Minimum 2 years.
2 to 3 years.
Yeah.
So if you're there for 6 months and then you've gone to the other place for 3 months, and they don't like that.
Yeah.
Then how long you've been at your employment. If you've been there for 6 months here, 3 months there, 6 months there, not a good sign. You got to have at least 2 years employment, or minimum 1 year with the previous 2 or 3 years. The other thing is, when we're looking at the application, the second red flag is, actually, to go back to the first one, the third point is, so we talked about the first one is job hopping, stability in employment, stability in residency, and then also income as well.
Yeah. And self-employed people, you've got to have at least 2 years worth of
2 years tax returns, yeah. So
tax returns,
BA
statements,
bad statements, notice of assessments that is being lodged.
Yeah, before you even think about getting a loan.
Correct, yeah. And making sure that you got enough, for self-employed clients, having enough money, net profit, that's left over. So I'm going to talk about a quick scenario with pay-as-you-go and self-employed. So pay-as-you-go, you're earning $150,000 a year, okay, as a plumber. You're working for somebody that pay you $150,000. The bank will use that $150,000 as a gross income for servicing, minus the Medicare levies and so forth. Now, if that person goes from pay-as-you-go to self-employed, does exactly the same job, identical as a plumber, so his gross turnover is $150,000. Then he takes all his expenses, car expenses, petrol, blah, 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 blah. Everything comes out and he's left with $40,000 net profit. That's what he's left after all the expenses. The banks will use $40,000, not the $150,000 as self-employed. Right. But if he was doing the pay-as-you-go, they use the $150,000. So this is where a lot of self-employed clients go, but I turned over $150,000, it was the same as pay-as-you-go. The banks don't see it that way. So you've got to make sure that you're on the right track with that.
And have more income.
Have more income. Okay. Now, we can add depreciation in there, add some add backs, but it's not enough. It may not be enough. So coming back to the flags. So that's one of the flags.
Yeah.
The second flag is card churning. So not a lot of clients, most clients, they go, oh, I can transfer this credit card to this credit card and I get my points. And I get interest free here. And I've had a client that had, I think, 8 credit cards and always churning them. Wow. And that affects your credit rating as well, because the banks say, oh, he's got another credit card, he's got another one here, this and that. And if you got too many credit cards churning, the banks don't like that. I understand you're getting interest free here, getting interest free there. Yeah. But when are you going to pay off that credit card?
No, they just assume you've maxed out on the cards and you're paying interest on the maxed amount.
Yeah.
It just shreds your ability to borrow.
Yes, that's the second red flag.
But of course, not only credit cards, car loans.
Car loans as well, yeah.
Don't buy a new car if you're going for a housing loan.
Correct, yeah, because you've got a lease in place, that's going to affect your borrowing capacity as well.
Yeah.
The third red flag is running late with your repayments.
Yes. Yeah.
Now, if you don't set up a direct debit, and let's say you get paid monthly on the 15th, but your repayment is coming out on the 13th, 2 days prior, that's a late payment. Even though you've made it 2 days later, the direct debit hasn't been set up correctly. And that's a red flag for the banks.
Yeah, absolutely. Set it up early.
Set it up earlier.
A day or two early.
Correct. Also, late repayments on credit cards, personal loans, car leases.
Yeah.
You know,
It's
shuffling.
14 days, I think it is, isn't it?
Depending on the banks, yeah.
Depending
on the banks. So that's the third red flag.
Yeah.
The fourth red flag is unpaid debts. The amount of times I see, we haven't paid our council rates. And I'm like, why? Because we spoken to the council and they said they've moved it for 30 days later. Okay, so you haven't paid that. We haven't paid the credit card, and we're in arrears on our credit card. So all these unpaid debts, electricity account, water, phone account.
Yeah.
So everyone's got a credit file, Vita or Dan Bradstone and so forth. So the banks look at that CCR report, credit report, and they say, Mr. Jones, you've got unpaid debts here. Please explain. What are you going to say? I couldn't afford it. If you can't afford these debts, how are you going to afford the mortgage? Thank you.
Discussion closed.
Discussion closed. Case closed. So that's the fourth red flag. The fifth red flag is making multiple applications, which I touched a little bit earlier. Yeah. So the multiple applications, we've had a customer that came to us and he went through a broker who was inexperienced. He was a broker for 6 minutes. And he got the application, put it through all these lenders, and he came to me and I had a look at his credit report and I said, why have you got 32 credit inquiries in the last 3 months? Okay, that's a lot of inquiries. I said, you've applied from this bank, this bank, this bank. He goes, the broker shopped it around. I said, okay, how long has this guy been brokering? It wasn't long enough, but anyway.
Not long enough to learn about it.
So I said, explain to the customer that this has an effect on you borrowing.
That's right.
Because if I go now to ABC Bank and they're going to say, what's these 32 inquiries? Has been declined? Yeah. And he goes, no, I didn't proceed with this one. The rate was too expensive. Why would you lodge it then?
Yeah, right.
So doing multiple applications, no. If you've got a good broker, the broker will sit down and say, okay, these are the banks, these are the rates, there's systems in place that we can show clients this is the everything. Okay, before we submit the application, we look at the servicing, we look at everything, look at your credit report. Okay, great. This bank, we'll lodge it. Yeah. Now, I'm not opposed to people doing 3 applications. That's okay. But if you're going to do 32, that's and why I said 3 applications is you might go to a bank and then they change the interest rate by 0.5%. Then we might go somewhere else. Or they may not like, their appetite is different because every bank's got a different appetite and policies in place. But you don't want to do multiple applications.
Sometimes it'll be where the property is or what it is. I mean, for example, in a new home unit development, one bank will never lend more than 25% on more than 25% of the units because they feel their exposure is too high.
Correct.
So you can be a perfectly good borrower and they say, well, actually, we can't lend because we've already lent our quota on that building.
On the building maximum, yeah. And that's one of the things I say 3 because we don't, as brokers, we don't know on that building
that's right.
Which mortgages, if there's 100 apartments and ABC Bank has got, 25 of them lend and they go, that's our maximum, we don't know. We don't get any reports saying, so
it's all secret.
It's all secret. We are going blind in that regard. However, what we basically, if the bank comes back, then they'll say, sorry, we can't lend for this customer because we're overexposed on this.
That's right.
Then we have to go to another bank.
Correct.
So that's why I say 2 or 3.
That's right.
Okay. So what I do is, if it's a complex, I actually send a request to our credit team in advance. You got to be proactive, not reactive. So I say, okay, this is 100 apartments.
Yes.
Can you find out how many in your, with the credit manager, are you guys overexposed?
Yeah. Are you above your 25%?
Yeah. If they say yes, we are, saying I'm not going to put the application. It's just common sense. And a lot of brokers, they go, it's just quickly.
They don't know about it.
They don't know. Inexperience. But
you don't ask if you don't know.
That's right, 100%. So they're the 5 red flags to make sure you look into these before you start applying.
Yeah, no, that's great. Okay, good.
Thank you,
Thanks,
Tony.
Wonderful.